Recently, a trade agreement has been reached between the European Union and the United States, effectively bringing an end to the so-called trade war between the two economic blocs. However, most analysts view the deal as more of a capitulation, or even a humiliation, of the European Union in the face of Donald Trump's demands. The agreement is truly regrettable for Europe. In addition to facing 15% tariffs on products exported to the United States, the EU has committed to massive purchases from the U.S., including $600 billion in arms and military equipment and $750 billion in energy products. Yet, a small group of analysts considers the deal somewhat positive, given that Trump had previously threatened to impose 30% tariffs. According to several analysts, the agreement accepted by Ursula von der Leyen, President of the European Commission, carries a more strategic and political background rather than being purely commercial. On one hand, the EU's willingness to make economic concessions to the U.S. aims to secure continued support from its main military ally in case tensions with Russia escalate. For now, it remains unclear whether a peace agreement between Ukraine and Russia is near or if the war could drag on. Putin appears to be waiting for signs of weakening Western commitment to Ukraine in order to intensify his attacks and push for victory. Some even argue that if, in the future, Putin were to attack another country bordering Russia, the European Union would unconditionally need the United States on its side to halt his expansionist plans, which remain deeply concerning. Maros Sefcovic, European Union Trade Commissioner, acknowledged that although he could not disclose details of the recent talks with Trump, he was emphatic in stating that the matter was not only about trade. Key figures in shaping the agreement included German Chancellor Friedrich Merz, French President Emmanuel Macron, and Ursula von der Leyen herself. They prioritized stable trade, political, and military relations with the U.S. over strictly economic interests. Moreover, without an agreement, tensions could have risen sharply, as the EU had been considering $100 billion in tariffs on U.S. exports to Europe. This would likely have triggered Trump to retaliate with tariffs as high as 30%. Chancellor Merz admitted that tariffs harm not only the EU, but also the U.S. An initial analysis by Capital Economics showed that higher tariffs could lead to an additional 0.5% decline in EU GDP growth, which is already struggling. Other experts, such as Holger Schmieding, chief economist at Berenberg, argue that the deal is entirely asymmetrically favorable to the U.S., reinforcing the narrative that negotiating with Trump always means yielding to his demands, an unfavorable precedent for future talks. Schmieding further projected that the tariffs will reduce Europe's potential growth by 0.33% and Germany's by 0.5% in 2025 and 2026. European stock markets reacted immediately. Germany's main index, the DAX, fell over 1% following the agreement, while Poland's stock market dropped nearly 2%. However, the DAX quickly rebounded in subsequent sessions. The euro also weakened against the dollar, reflecting market skepticism about the deal's benefits for Europe. Chancellor Merz recognized that Trump remains determined to raise tariffs, citing the U.S. trade deficit with Europe and possibly seeking to boost his declining popularity. In that sense, Trump has a point. The U.S. trade deficit with Europe stands at $197 billion, with only $334 billion in exports versus $532 billion in imports. However, these figures only account for goods. When services are included, the picture changes drastically. The U.S. exports over 430 billion euros in services to the EU while importing 319 billion euros, leaving a surplus of 111 billion euros. This means the actual deficit that Trump used to justify tariff hikes is under $90 billion when both goods and services are considered. The negotiations have highlighted the EU's weakness, as it seemingly lacked a strong leader to confront Trump, whom Ursula von der Leyen has described as an excellent negotiator. It is worth recalling that Trump has his own negotiation philosophy, outlined in detail in his 1987 book, The Art of the Deal. There, he described strategies involving psychology, preparation, and projecting power, tactics likely used in these talks with the EU. Among these is controlling the narrative. In this case, Trump successfully promoted the idea of a massive U.S. trade deficit, blaming other countries, a claim that remains highly debatable. Another principle is remaining unpredictable, instilling fear of retaliation. The EU, wary of potential reprisals and higher tariffs, avoided confrontation. Looking closely at the agreement, one of the few positive outcomes for Europe is a reduction of tariffs on automobiles from 27.5% to 15%, which could help European automakers expand in the U.S. market. The automotive sector, currently Europe's third largest, exports €39 billion worth of vehicles to the U.S. The deal could particularly benefit German manufacturers, such as Mercedes-Benz, BMW, and Volkswagen. Airbus could also gain, as the aerospace sector avoided tariff increases. On the downside, however, aluminum and steel producers will face a punishing 50% tariff. Combined with growing competition from China, offering increasingly cheaper products, this could severely harm the sector. Although these industries represent only 1.5% of EU exports, the damage could still be significant. One of the most affected sectors would be French wines and spirits, as cognac, French champagne, and wine together represent half of all European beverage exports to the United States. There is still no clarity on whether these drinks might receive an exemption. If no exemption is granted, European wines facing 15% tariffs could lead to the loss of up to 17,000 jobs, mainly in France and Italy. France would also be hit in the luxury goods and cosmetic sectors. Products that previously faced zero tariffs will now face a 15% rate, impacting companies like LVMH, owner of Louis Vuitton and Christian Dior, and L'Oreal. In this sector alone, more than 500 jobs are at risk. The situation is not favorable for Spain either. The 15% tariffs on food products threaten the €3.3 billion in annual exports to the U.S., representing 6.6% of Spain's total exports. Among the affected products are olive oil, of which nearly 180,000 tons are shipped each year, making Spain the world's second-largest supplier to the U.S., as well as wine, olives, canned seafood, fresh fruits and vegetables, Spanish cheeses, cookies, and sweets. On the positive side, certain sectors will benefit from zero tariffs, including semiconductor equipment, supplies for the aerospace industry, some chemical and agricultural products, and key raw materials. Several European political leaders, such as French Prime Minister François Bayrou, had described the agreement as unbalanced, even calling it a dark day for Europe. German Chancellor Friedrich Merz also admitted defeat, stating that the deal will cost European companies billions of euros, though he acknowledged it was aimed at preventing trade relations from deteriorating further. However, some analysts argue that the purchase commitment supposedly made by the EU, $250 billion annually over the next 3 years in energy products, especially liquefied natural gas, and in military equipment, are unrealistic. On one hand, the U.S. does not have that level of production capacity, and on the other, Europe cannot absorb such volumes. To put this into perspective, all U.S. energy exports currently total $166 billion annually. Even if Europe bought the entire amount, it would still fall short of the agreement's target. Thus, part of the deal seems more like headline-making announcements designed to showcase a media victory for Trump rather than realistic figures. According to some analysts, the EU strategy may have been to let Trump feel like the winner, partially fulfilling the commitments, and then seeking to renegotiate in 3 years with a president more realistic about the numbers. Nevertheless, Trump's apparent victory is not entirely so. Tariffs will inevitably raise import prices, which in turn will impact inflation. Some projections already suggest inflation could reach 3.5% by the end of the year, well above the Federal Reserve's and Powell's expectations, limiting Trump's hopes for rapid interest rate cuts. Additionally, analysts like Schmeeding forecast that tariffs and institutional instability in the U.S. will hurt economic growth, lowering projections from 2% to 1.5%, a 0.5% decline. This weaker growth could further strain public finances and fiscal risks, as government revenue would fall short of expectations. U.S. citizens will also feel the impact, as in the medium and long term, consumers will ultimately bear the cost of the new tariffs, with most companies likely passing on the added expense. Trump is, in effect, reshaping the global trade landscape with less international freedom and stronger U.S. protectionism, policies that run counter to the free market principles that Americans once so strongly defended. Still pending is a negotiation on the services sector, where, as previously noted, the U.S. enjoys a trade surplus with the EU. It remains to be seen whether Europe can gain some ground there to offset the current unbalanced deal. Remember that in the video description, you'll find a link to the best course for learning technical and fundamental analysis to invest in stocks. You'll also find a link to the best U.S. regulated platform to buy shares. If you enjoyed the video, give us a like, subscribe to the channel, and share the content.